Over a year ago, I made a video titled, "This ETF is now my favorite dividend income holding," in which I presented my new favorite high-yielding dividend investment. SPYI, also known as the NEOS S&P 500 High Income ETF, had only been around for less than 2 years at that time. But based upon everything that I was reading and its performance up to that point, I believe that SPYI was going to be a really worthwhile dividend investment. And what we went through in the early part of 2025 served as a major test for this ETF, which had never gone through anything serious up to that point. In a very short amount of time this year, the S&P 500 fell by 19%, all within the span of about 6 weeks, which is pretty extreme for that short amount of time. As it's commonly well known, these covered call funds are notorious for having limited upside potential. We've seen that with much older funds in this category, and it's just the nature of the strategy they use. You should never expect the share price of a CC fund to perfectly match the share price of the index it uses options on. But this ETF by NEOS has been standing out as having a better strategy than other CC funds. It sells covered calls, which, if you're not too familiar, is when a fund holds an asset while selling a call option on that same asset in exchange for a cash payment, referred to as an option premium. The call option is a contract that states that the seller is required to sell the underlying asset at an agreed price by a specific date. That's regardless if the asset is going to be worth more, it still has to sell at the agreed price, also known as the strike price. So you can see that there's going to be some limited upside with share price growth. If I own a stock that's trading for $20 and I sell a call option on my stock with a strike price of $25 in 30 days, and after a month it's worth $30, I'm still only getting $25. Keeping that in mind, how well of a job has SPYI been doing when looking up the S&P 500? Has it been trailing behind significantly? If we look at the index and the NEOS fund side by side to each other, we can see that SPYI hasn't been too far behind in share price. For the majority of the year, it was virtually neck and neck with the index. But with all covered call funds, on those days when the market really jumps up, that's when these ETFs can trail more. We've been seeing that over this last week, where the S&P 500 saw some pretty significant single-day gains. For example, on Monday, May 12th, the index climbed 3.3% in a single day, and any covered call fund using options on this index wouldn't be able to fully keep up with that. But although SPYI doesn't perform as well as SPY from a share price perspective, what makes up for that is its extremely high dividend yield. The S&P 500 itself currently offers a dividend yield of only 1.29%. SPYI, on the other hand, currently yields 12.11% as of the making of this video. That makes up for the lack in share price when looking at total return. Right now, SPYI is up for the year and slightly beating the index itself. This again is total return, which would include the dividend payments, and it assumes that you're reinvesting them back into buying more shares of the ETF. You have to look at this when analyzing any dividend-paying fund and not just looking at the share price performance. We can also see how well your returns would be if you weren't reinvesting the dividends. So for example, if you weren't reinvesting the dividends and you were instead living off the distributions, or if you were taking the dividends from this holding and were using them to invest in other positions in your dividend portfolio, we can see the returns would be pretty much even with the S&P, only a nominal difference. In this scenario, the dividends from SPY would also not be invested. Another unique feature about this fund is that because it's actively managed and not passively managed like other CC funds, the managers can employ certain techniques depending on the market. Nothing fundamentally different than what's already outlined in their prospectus, but this ETF can try to take advantage of tax loss harvesting situations. In addition, it also uses SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. As I previously talked about in older videos, before I held this ETF, I held a different S&P 500 covered call fund. That holding was XYLD, which is the Global X S&P 500 covered call ETF. When I first started dividend investing, this was the only CC fund that wrote covered calls on the S&P. I also used to hold QYLD and RYLD, two other funds that use options on the Nasdaq and the Russell 2000. XYLD was launched all the way back in 2013, and SPYI wouldn't come into existence until much later, until August of 2022. Looking at XYLD's performance and comparing it with SPYI, it makes me pretty happy that I decided to make the switch a while ago. You can see that since April, XYLD has been significantly struggling to gain upside in share price. But now let's compare it to SPYI, and you'll see how drastically better the NEOS fund is at capturing upside. This chart only captures share price gains and doesn't account for total return, again, which includes the dividend distributions. But that's another thing. SPYI has not only offered better upside capture, but it yields more than the Global X ETF. So given the better upside and the higher dividend yield, I think it's proven that SPYI is the better covered call fund here. So let's now compare the NEOS fund to other options that exist for this index. We'll start with XYLD. The Global X fund is currently trailing when it comes to total return, and it's actually down sizably for the year. It's definitely a disappointment. Although it was the original fund in this category, it does go to show that other companies like NEOS saw what Global X was doing and they decided to improve upon it. Let's now look at XDTE, which is Roundhill's S&P 500 covered call fund. This one is actually a synthetic covered call fund, so it is a little different than the others. A synthetic CC fund doesn't actually own the underlying securities or index fund or whatever its focus is on. Instead, it seeks to replicate the price movements of the underlying asset or assets using intricate option strategies. What is this translated into so far? Much more volatility and even poorer upside. XDTE is still down 12.81% for the year in share price. But the biggest appeal of these funds is their significant dividend yields, and sometimes they pay weekly dividends instead of monthly. This ETF currently touts a yield exceeding 30% according to its website, and it does pay weekly. However, despite this incredible yield, it hasn't translated into beating SPYI. As of the making of this video, XDTE is still down for the year, posting a negative return of 2.44%. Although that is better than XYLD, the fact that it has a difficult time in gaining share price I think is a legitimate concern for this fund. I think it could be a great holding during better times, or if you're the kind of person who's willing to rotate out of specific investments when the markets start taking a downturn. Of course, the main issue with that is you're basically trying to time the market. Just a couple of months ago, many people thought that we were heading for a prolonged bear market, but that now appears that that might not be the case. Finally, we'll compare SPYI to JEPI, even though it's not a totally fair comparison. JEPI isn't tied to the S&P, but it does hold a significant amount of positions in this index. It also dedicates 20% of its portfolio holdings to equity-linked notes, which aren't company stocks. JEPI's year-to-date performance is pretty close to SPYI, and it does have some features that would make this ETF more appealing to some people than the NEOS funds, but as of right now, it's still trailing behind slightly. SPYI isn't the only ETF that I hold by this fund provider. I've also been a shareholder and a fan of QQQI, which is the same as SPYI, only it's on the NASDAQ 100. Again, I decided to replace QYLD with this ETF, and it's also done very well this year. I guess it won an award recently from ETF.com for the best new active fund of 2025. I've always held fewer shares of this fund for two main reasons. First, the Nasdaq has historically been less diversified as it's been a very tech-heavy index for a long time. The second reason is that it's more volatile than the S&P. During that same time when the S&P 500 fell by 19%, the Nasdaq fell by almost 22%. So those are the two reasons why, and that's despite QQQI offering a higher yield, and it has still been doing really well this year when looking at total return. It's just barely trailing the index itself, but it's currently up 2.19% for the year. So as you can probably tell based upon how I'm speaking, I'm really glad that I went with both of these ETFs. Both ETFs went through a pretty good test this year and both came out on top, while most of the other CC funds are still lagging behind. Let me know if you've been holding either of these two funds, or if you prefer a different covered call or high-yielding investment during these times. But with that being said, thanks for watching today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher-yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.